In Q1 of fiscal year 24, the Indian economy saw 7.8% GDP growth, garnering much praise. Now, while favorable base effect played a substantial role in making the growth rate seem larger than it would under normal circumstances, positive trends in private consumption, investment activity, and strong performance of key sectors like services, manufacturing, and construction did indicate a resilient economy despite many challenges thrown its way. Now, the Q2 figures are expected to be released next week. The Reserve Bank of India is throwing in an estimate of about 6.5% growth for the July to September quarter. Now, that's a bit below the June quarter growth, mainly because of favorable base effect fading away. Now, let's look at some economic indicators to see how the Indian economy is shaping up and understand what would be the key drivers for the economic growth in the second quarter of the fiscal year 2024. Now, before we jump into the Q2 specifics, let me give you a quick breakdown of how GDP works. Now, GDP is broken down into four key components, each playing a crucial role in driving economic growth in the country. Now, first, we've got private consumption. That's the money spent by consumers like you and I. Then we've got gross fixed capital formation or investments, which is called I for short. This covers spending by firms and the government on things like machinery, equipment, etc. Then comes the G component, which is government consumption and investment. The net exports component is the difference between what a country exports and what it imports. And in India's case, because we tend to import more than we export, this component often has a negative impact on GDP growth. So when you add all of these elements together, you get the grand total of GDP. Now, coming to the indicators for Q2. Indicators seen as a proxy for urban demand, such as sales of domestic passenger vehicles and domestic passenger aviation traffic, saw some impressive growth, posting about 21.5% and 23.1% growth respectively. Now, another important indicator, bank credit, also grew by 19.8% in the September quarter. The PMI services index came in at 61.1 in Q2, a slight bump from the 60.6 in the previous quarter. Industrial production in the country also saw a considerable uptick. Lastly, there's been a strong pickup in steel consumption and cement production on the back of government capex and construction activity picking up. So summing it up, Q2 looks like it's going to be all about private consumption fueled by urban demand with a strong supporting role played by government spending. However, one downside risk is rural consumption, which is still yet to see a meaningful pickup. Now, Indians are really diving into digital payments, and it's causing a noticeable drop in the amount of cash floating around. For the second time in 2 decades, the currency in circulation took a hit during the Diwali week. According to a report by SBI Ecowrap, during this Diwali week, the currency in circulation went down by rupees 5,900 crore. Now, last year it fell by 7,600 crore during the same period. Now, this can be primarily attributed to the success of the growing digital payment ecosystem in the country. Notably, over 11 billion transactions worth rupees 17.16 lakh crore via UPI took place in the festive month of October. Now, the decline in currency in circulation mainly has two benefits. The RBI doesn't need to print as much currency, leading to cost savings. Additionally, a shift towards a less cash economy aligns with modern trends in digital payments and can have various benefits, such as reducing the risk of counterfeiting and making transactions more efficient. This can also be beneficial for the banking system as it results in fewer withdrawals of cash, which in turn can positively impact banking liquidity. With more cash reserves, banks can offer loans to borrowers for various purposes such as business expansion, investment, etc., which will propel economic growth. Having said that, this is me, Merlin Sana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com